Welcome to Talk Tickers. We are deep in the trenches of earnings season, stripping away the noise to find the actual signal.
And there is a lot of noise out there.
There is. Usually when we talk about telecom infrastructure, we are, preparing for a conversation that's reliable, utility-like, and frankly, a little boring.
Yeah, that's fair.
But today is different. Today we're looking at a legacy giant that just woke up and chose violence, financial violence. We're breaking down the Q4 2025 earnings call for Ericsson.
It really was a statement. You just don't often see a company this mature in a sector this flat come out swinging the way they did.
And the market definitely noticed.
Oh, absolutely.
We saw Stockholm shares pop nearly 12% intraday. The US ADR closed up nearly 9%. I mean, that is a massive move for a large cap industrial stock.
It's huge.
But I want to start by asking a question. We see these pops all the time, right? Sometimes it's just a relief rally because the news wasn't a total disaster. Was this that?
Wow.
Or was this a genuine repricing?
That is the most important question. And I think the data says this was not relief. This was a fundamental repricing of the company's credibility.
Credibility. Okay.
For a long time, Ericsson has been a show me story. Investors were waiting for the turnaround to, actually turn. This quarter, it's like they realized two things at once.
So are they?
First, that the business has transformed into a cash-generating machine. And second, that there is a legitimate tech pivot happening. Something around physical AI and defense that just changes the whole growth story.
Okay, we have a lot to unpack there. Physical AI sounds a little like marketing buzz, but we'll get to it.
Yeah.
And we absolutely have to talk about this sensing technology.
Where they're turning cell towers into radar systems, yeah.
But before we get to the sci-fi stuff, we have to eat our vegetables, the cold, hard financials. Why exactly were investors throwing money at this print?
Because they just smashed expectations on the metrics that actually matter. Let's look at the bottom line. GAAP earnings per share came in at SEK 2.57.
Which is roughly what in dollars?
About 27 cents. The consensus on the street was sitting at 23 cents. That's a 17% beat.
And just for our listeners, you're emphasizing GAAP there. Why does that distinction matter so much versus the adjusted numbers we usually hear?
Great point. GAAP is the strict by-the-book standard. No creative accounting, no adjustments to make things look prettier.
So this is the real number.
This is the real number, and they beat it soundly. That just screams quality.
Okay, so the profit was real. What about the top line, revenue?
Revenue hit SEK 69.3 billion, so about $7.36 billion. That also beat the expectation, which was around $7.03 billion.
So there's a but, isn't there?
There is. And this is where it gets tricky. The reported revenue was actually down 5% year over year.
Right. And that's the disconnect. Usually, if you tell me sales dropped 5%, I'd expect the stock to be red, not up 12%. So how do you reconcile that?
It all comes down to currency versus reality. The reported number was dragged down by foreign exchange rates. But if you strip that out and look at organic growth, which is the actual volume of stuff they sold, they were up 6%.
So they actually sold more gear. But here's the tension I found in the call. Management was brutally honest. They said the global market is flat. They don't expect it to grow in 2026.
Not at all.
So if the pond isn't getting any bigger, how do they catch more fish? How do you grow 6% in a zero growth market?
You do it by being ruthless. And that brings us to the first major theme here, execution. They are executing incredibly well on what they can control.
Which is cost.
Mostly cost and efficiency, yeah. They kept 5,000 jobs in the past year. They just announced another 1,600 cuts in Sweden.
Wow. I mean, that sounds harsh, and it is for those people. But from a shareholder perspective, that's efficiency.
It is. It's what the market demands. And you can see the results of it in the margins. Adjusted gross margin hit 48.0%. That is up 170 basis points year over year.
Okay, put that in context. Is 170 basis points a lot?
In this world, in hardware and infrastructure, it's massive. Companies fight tooth and nail for 20 or 30 basis points. This proves the cost cutting is working. It's structural.
So they fixed the house, they stopped the leaks. And that leads us to the part that probably got the trading floor most excited, the capital return.
The cash cannon.
Is that hyperbole or is that accurate?
It's an entirely appropriate description. Management announced a total distribution of 25 billion SEK to shareholders.
Okay.
They raised the dividend to 3 krona per share, which is nice. But the real story, the headline that really matters, is the buyback.
Break that down for us. Why is the buyback the big headline here?
Because it's the first ever formal buyback program in Ericsson's entire history.
Wait, hold on. In their whole history, they're over 100 years old. They've never done a buyback.
Not like this. Never a formal large-scale capital return program. It signals a massive shift in their whole corporate psychology.
From what to what?
For decades, they were either in build mode or, crisis mode. They hoarded cash because they were afraid of the next downturn. Now, they ended the year with over 61 billion SEK in net cash, a fortress balance sheet. By initiating a buyback, they're finally telling the market, we are stable, we are confident, we're giving the cash back to you.
That has to create a psychological floor under the stock price, right? The company itself is now a buyer.
Precisely. It turns the stock from a risky tech play into a value play with a yield and a safety net.
Okay, so the financials are rock solid, but you can't just cut your way to growth forever. You need a vision. CEO Berger Echholm spent a lot of time on the call talking about physical AI.
He did.
Now, my skepticism radar pings hard when a non-AI company starts talking about AI. Is this just marketing, or is there a real technical argument here?
I share that skepticism, but I think the technical argument actually holds water. Here's how he frames it. For the last 2 years, the AI boom has been all digital.
Right. Stuff that lives in the cloud, LLMs, chatbots, image generators.
Exactly. Echholm is arguing that the next phase is physical AI. This is where AI leaves the data center and enters the real world. Think autonomous drones, humanoid robots, XR glasses, real-time translation.
Okay, but we've had robots in factories for decades. Why is this different? Why can't they just run on Wi-Fi?
That is the multi-billion-dollar question.
Yeah.
And the answer is the difference between how our networks are built versus what these robots need. Our current networks, 4G, Wi-Fi, they're all designed for downlink.
Meaning consumption. We download movies, scroll social media.
Right. The data flows from the cloud to us. But physical AI flips that completely. A robot is a moving bundle of cameras and sensors. It needs to send massive amounts of data back to the cloud.
It's all uplink.
All uplink. And you need zero latency. You can't have a 200 millisecond lag when a robot is carrying a heavy load next to a human. 4G just can't do that reliably.
So the argument is, if physical AI is going to happen, our current infrastructure physically cannot support it.
Correct. They need 5G standalone.
We hear that term a lot, 5G standalone. Most people see 5G on their phone and think they have it. What's the real difference?
Think of it this way. Most 5G today is non-standalone. It's like putting a Ferrari engine in a Honda Civic. It's faster, but it's still limited by the old 4G core network.
And 5G standalone.
That's the Ferrari engine and the Ferrari chassis, a pure 5G core. It's the only way to get that ultra-low latency and massive uplink.
So what's the market penetration for that right now? How many networks are actually the full Ferrari?
And that's the opportunity. It's only about 25% of global networks outside of China.
Wow, that is surprisingly low. I assumed we were further along.
We're not. And that's Echholm's whole pitch. If physical AI is going to happen, that other 75% of the world's networks has to be upgraded. That's a massive spending cycle the market has not priced in.
So it turns Ericsson from a boring utility play into a pick and shovel play for the next wave of automation.
That's the idea.
That makes sense. But there was another pivot that sounded a lot less like Silicon Valley and, honestly, a lot more like a spy novel. Let's talk about sensing and the defense angle.
This was the most surprising part of the call for me. They explicitly highlighted defense and mission-critical networks as a key growth area.
How does a cell tower become a sensor? Break that down.
It's actually pretty simple physics. 5G uses radio waves. When you send those waves out, they bounce off of objects, cars, buildings, drones.
Like radar.
It's very similar to radar. By analyzing how those signals get disturbed between two towers, the network can calculate the position, speed, and size of objects moving through the air.
So if a drone is flying near a tower, even if it's not broadcasting anything, the tower knows it's there.
The tower sees it. It effectively turns the entire cellular grid into a massive distributed radar system.
That is wild. Why is the defense sector suddenly interested in this?
Two big drivers. One, geopolitical tension is up, so spending is up. But two, the military is realizing that their own proprietary tech is slow and incredibly expensive to upgrade.
They want to buy commercial off-the-shelf stuff.
Exactly. Use standard 3GPP tech. It's cheaper. It iterates faster. Ericsson is telling governments, you don't need a new radar grid to track drones. You already have one. Just let us upgrade it.
That is a very compelling pitch. Okay, let's touch quickly on the enterprise side. We've talked about Vonage and APIs before. Is that finally moving?
It's showing a pulse. Vonage was the first to get aggregated access to APIs across all three big U.S. carriers.
And just to remind the listener, an API here lets a developer ask the network a question, right?
Right. Like, is this phone really where it says it is?
Yeah.
Or has the SIM been swapped? So the killer app right now is fraud detection.
Makes sense. And private 5G.
Still very early days. Sales were actually down a bit there, so it's not a cash cow yet.
Got it. Let's zoom out to the investor context. Geographically, where's the strength?
It's a mixed bag. The winners were EMEA, so Europe, Middle East, Africa, and Vietnam. Strong growth.
And the losers?
Northeast Asia declined. And the Americas were stable but complicated. North America is healthy, but Latin America is suffering from really intense price wars.
They also mentioned China as a competitor in AI.
Yeah, that was a warning shot. Echholm pointed out that China's 5G grid is 10 times denser than the rest of the world.
More towers per square mile.
Exactly. And his argument was, if you want a self-driving city, you need that density. He was basically lobbying Western governments, saying, if you want to win the AI race, you need to let us build more.
Clever. Okay, what about the risks? What could derail this?
The big macro clouds, tariffs are the obvious one, and the supply chain is getting tricky again. Memory prices are rising.
So inflation is still a factor.
It is. If their costs spike faster than they can raise prices, those beautiful margins we talked about will shrink.
Got it. Okay, we have covered the numbers, the tech pivots, the geopolitics. Now it's time for our favorite segment.
The legal team's nightmare.
Exactly. The "this is not financial advice" segment, where we take the data and construct an outrageous but plausible trade idea. Again, to you, the listener, do not do this.
Please do not lose your savings on our speculation.
What have you got for us today?
I'm calling this one the invisible radar play.
Okay, I'm listening.
The setup is this. Echholm dropped that crumb about using 5G towers for sensing and drone detection.
Right, the cell tower grid is a radar grid.
Now combine that with the physical AI idea. If Amazon, Walmart, and everyone else start flooding the airspace with delivery drones, governments are going to panic about how to track them.
And you can't build a traditional radar station on every street corner.
Exactly. So Ericsson isn't just a telecom stock anymore. It is a stealth defense and surveillance contractor.
So what's the trade?
You go long Ericsson. But you pair it with a short-on legacy hardware-heavy radar manufacturers, the companies that make those big spinning dishes at airports.
So you're betting that software-defined 5G networks will cannibalize traditional airspace monitoring.
It's the ultimate software eats hardware play. Why buy a new radar dish when you can just download a software update to your 5G tower?
That is deliciously aggressive. I love it. And again, absolutely not financial advice, just a thought experiment.
Strictly for entertainment.
So let's bring it home. What's the final takeaway for the listener? How should they think about Ericsson right now?
I'd say Ericsson delivered a credibility print. That's the headline. Margins are up. Cash flow's massive. They're finally buying back stock. They prove they can make money even when the market is flat.
So that removes the downside risk?
It does. And the upside is that you get a free call option on the future of AI. You buy for the cash flow, and you hold it in case Echholm is right about physical AI. If the robots come, Ericsson wins big. If they don't, you still get a nice dividend.
A compelling risk reward. The stock jumped because investors realized this isn't a growth story anymore. It's a cash extraction story with a really exciting lottery ticket attached.
That's the perfect summary.
Thanks for listening to Talk Tickers. We'll see you at the next print.
Goodbye.